welcome to This Explainer. Today, we're putting on our financial detective hats to uncover exactly why raw cash is so often, well, just an illusion hiding a company's true health. You know, if you've ever looked at a massive bank balance and automatically thought, wow, that business is thriving, you might actually be falling for the oldest trick in the financial book. Today, we're going to absolutely shatter that illusion.
To get us there, we're breaking this explainer down into 4 quick chapters. First, fixing that cash illusion. Then, we'll look at time-shifting adjustments. After that, the very real cost of offering credit. And finally, preparing for the unknown. All right, let's jump right into Chapter 1, Fixing the Cash Illusion. We really need to look way beyond the bank balance to uncover our primary motive here.
As our source material puts it perfectly, the whole point of making these adjustments is so the financial statements present a true and fair view of the company's performance. And getting to that true and fair view, well, it means looking way past the bank account. Because, look, cash tells you what happened to your wallet, right? But accrual accounting, our core tool here, that tells you what actually happened to your business. So, we really have to ask ourselves, if a business has a ton of cash, why on earth might it still be failing? It sounds counterintuitive, doesn't it? But the answer is simple. If you're only looking at the cash flowing in and out, you are completely ignoring the reality of unrecorded liabilities, unpaid bills, and all those future obligations that just haven't hit the bank statement yet. It's like celebrating a huge paycheck while forgetting your mortgage is due tomorrow.
Which brings us right to Chapter 2, the 4 time-shifting adjustments, where we look at matching revenues and costs. To fix this cash illusion, we need a very specific set of tools.
And to find the truth, we actually follow this incredibly logical 6-step sequence. First up, we identify any transactions that span across different periods. Then, we gather the exact source documents. From there, we calculate the adjusting amount, prepare the formal journal entries, post those bad boys directly to the general ledger, and finally, adjust the trial balance. This whole rigorous process ensures that every single revenue and expense is matched exactly to the period it belongs to, not just when the cash happened to change hands.
So our first tool for literally bending time is the accrual, or an accrued expense. This basically forces us to recognize a liability that we owe right now, even if the physical invoice hasn't actually shown up in the mail yet. It's an expense we've incurred, we just haven't paid it yet. Let's put that into perspective. Imagine your team worked the last week of December, but payday isn't until the first week of January. The actual work happened in December, right? So this 1,000 rupees in weekly wages is an accrual we absolutely must record to reflect the true cost of doing business in December. If we don't do that, December looks artificially profitable, and January looks, well, artificially terrible. And if you fail to capture any of these 4 time-shifting adjustments, you're going to end up with a completely false picture of your net assets. You can see the mechanics playing out here. Accruals and deferred income, they drag your profit and net assets down to reality, while prepayments and accrued income actually push them up. You literally have to capture all 4 of these to see the true picture. Conversely, let's talk about deferred income. Say we receive 3,000 rupees for 3 months' rent on December 1st. We might feel pretty rich in that moment. But by December 31st, we've only actually earned 1 month of that cash. We have to defer 2/3 of that income, 2,000 rupees, into the future simply because we haven't earned it yet. We literally shift it from revenue on our profit statement straight into a liability on our balance sheet because, well, we still owe the tenant 2 more months of space. Okay, now that we've successfully bent time, we have to deal with the sheer unpredictability of human behavior. Moving on to Chapter 3, the cost of offering credit and managing receivables. Look, offering credit to your customers is a total double-edged sword. On one hand, it's fantastic for business, right? It attracts customers, it builds loyalty, gives you a nice competitive advantage. But it invites this dark reality. I'm talking massive administration headaches, cash tied up doing absolutely nothing, and the inevitable, painful sting of irrecoverable debts when customers just up and ghost you. To manage all this chaos, we use what's called an aged receivables analysis. This is essentially how we hunt down overdue accounts. We bucket our receivables by age, which lets us easily spot high-risk debts. Take customer X here, for instance, who unfortunately went bankrupt while owing us 1,000 rupees in the 60-plus days column. When a situation like that happens, we have to bite the bullet and formally write it off as an irrecoverable debt expense. But here's the thing. We don't just sit around waiting for customers to go bankrupt. Notice how we've proactively carved out an estimated 2,000 rupee allowance from our total receivables. This acts as a negative asset,
Think of it like a shield, protecting our financial reality from future defaults before they even happen. That leaves us with a much more realistic carrying amount of 98,000 rupees. And to further protect our business from errors or even fraud on the other side, meaning what we owe to our suppliers, we have to rigorously reconcile our supplier statements. By methodically comparing ending balances, taking off matching invoices, and hunting down any unpresented invoices or outstanding payments, we make absolutely sure our payables ledger perfectly mirrors reality.
Which brings us to our final chapter. Our financial detective now has to look into the crystal ball and prepare for things that haven't even happened yet. Chapter 4, Preparing for the Unknown Through Future Provisions.
The absolute crucial point here is understanding the threshold of reality when it comes to future risks. We basically have two categories. If a future loss, like, say, a pending lawsuit, is probable and we can reliably measure it, it crosses the threshold into a provision, and we have to record it as a liability today. But if it's only possible, it remains a contingent liability. For those, we just disclose them in the notes without actually hitting the balance sheet.
So let's look at how we measure these provisions when we're dealing with huge volumes. To calculate a provision for a massive population, we use probability-weighted expected values. For instance, imagine we just sold 10,000 laptops with a 1-year warranty. Based on past data, we know 93% of them will be totally fine. 5% are going to need a 50 rupee minor repair, and 2% are literally going to explode and need a 200 rupee major repair. By doing the math and multiplying those probabilities across all 10,000 units, we calculate an expected cost of 25,000 for the minor repairs and 40,000 for the major ones. So we immediately recognize a precise warranty provision expense of 65,000 rupees today. This makes sure our current profit reflects the true cost of those future repairs, tied directly to the revenue we just made from selling them. But remember, these provisions are not set in stone. They're living, breathing estimates. If we look at the life cycle of a provision, we start with an opening balance, we add our new $65,000 estimate, we deduct what we actually ended up using, and we can even reverse unused portions if our initial estimates were just too high. We adjust this whole thing, up or down, at every single reporting date to ensure our financial statements always reflect the absolute best estimate of reality.
Ultimately, raw cash accounting is really just a comforting story we tell ourselves. The actual reality of business is so much more complex, filled with time-shifting obligations, credit risks, and future unknowns. So I'll leave you with this question. What financial illusions do you need to shatter to see the true, unvarnished reality of your business? Thanks so much for joining me on this explainer, and I'll catch you next time as we continue to decode the financial world around us.